Hi everyone and welcome to the channel. Today I'm gonna talk about how to reach financial independence in 5 simple steps in 2024. So stay tuned because the video is gonna start right now. Let's start saying that financial independence is the state whenever you have enough money to sustain your lifestyle even without working. So let's be honest, most of the people around us would like to achieve this state of play. And I can tell you that despite what you can think, it is easier than expected to reach this kind of goal. Let's start immediately with this series of 5 simple tips. My first tip is to cut unnecessary expenses. This might seem obvious, but it is not that easy. It's easier said than done. If you stop for a second, you can realize immediately that you have expenses for stuff that you don't really need. If I have to look to my personal sphere of friendship, one of the most common expense that many of them do is buying a new car as soon as a new model comes out. And by doing so, keep paying really expensive installments every month just to buy this new fancy object that doesn't bring any value added. Everyone would like to boast off showing a new car, come on. But it is gonna cost a lot. My second tip is to pay off as soon as possible high interest debt. High interest debt drains cash as fast as possible from your bank account, and this is something you would like to avoid. The reason is pretty simple. High interest debt drains cash from your pocket that otherwise you could invest in fruitful activities or even saving just in case you are particularly lazy or risk averse, let's say. But now you can ask me how you can get rid of this debt. Well, you have two options. The first one is called debt snowball plan, and the second level is the debt avalanche plan. I invented these terms really like winter, quite inventive, let's say. But let's move on. With the debt snowball plan, you plan to pay off the less cumbersome debt first, or those one with the lower interest rate and the lower amount. This can clearly help you stay motivated, and you can see immediately some effect on your cash balance. With the debt avalanche plan, on the other hand, you plan to pay the more cumbersome debt as first, which in theory are also those one bearing the high interest payment. This second approach will take definitely longer, but trust me, it's gonna pay off way more in the long run. You're gonna save big money. Third tip, build an emergency fund. An emergency fund is an account that you use in order to face unexpected expenses, such as medical treatment, the reparation of the car, or in case you lose your job.
Chief, I found Parker.
Where you been? Looking for you all morning. Why don't you pay your phone bill? Mad scientist goes berserk and we don't have pictures.
I heard Spider-Man was there.
Where were you? Photographing squirrels? You're fired.
Chief, the planetarium party.
Oh, right. You're unfired. I need you. Come here. What do you know about high society?
Consider also to establish an emergency fund before you start investing. Simply because, just in case you invest it first, the cost of liquidate your investment in case of need may imply that you will lose money, because selling under time constraints, of course, will impact the sale price, and you have to lower it down. That is never a good idea. One general principle of investing is buying low and selling high, not vice versa. Right? My personal approach towards emergency fund is to set aside at least 3 to 6 months survival period. That is an amount that will allow me to sustain living expenses without any material impact on my lifestyle. And I will never consider to buy something if I don't have at least twice as much the liquidity I will need in order to buy it. This will grant me a safety buffer in order not to have a distress situation going forward, not to have to liquidate my investments sooner than expected. The fourth tip is to start investing. Investing is one of the best way to grow money over time. When you invest, basically you put money working for you, and you don't have to monitor them every day, all day long. It's like having an employee. Basically, you put it there, you give it an order, and he cares about the execution. That is, generating more money. The nice thing is that you can invest in a variety of different assets. Stocks, bonds, real estates, derivatives, paintings, gold, silver, antiquities, diamonds, whatever. Anyway, the key for successful investing is to start early and for the long run. So don't be impatient. Keep calm and carry on. So just to give an example, if you take into consideration one of the most known stock indices, the S&P 500, on average it returns something like 10% per year. That is not bad. Of course, we had episodes of massive volatility, such as in 2008 with the subprime debt crisis, or more recently in 2020 with the COVID outbreak. But the good thing is that on average, stock indexes demonstrate their ability to recover over time, offsetting short-term volatility episodes. In this light, just to quote Charlie Munger, if you're a stock investor, you have to be prepared to 50% volatility, top tick to bottom tick. Otherwise, better for you to look for something else.
How worried are you by the declines in the share price of Berkshire Hathaway, the difficulties the
Zero.
company's in?
This
No?
is the third time that Warren and I have seen our holdings in Berkshire go down top tick to bottom tick by 50%. In fact, you can argue that if you're not willing to react with equanimity to a market price decline of 50% 2 or 3 times a century, you're not fit to be a common shareholder, and you deserve the mediocre result you're going to get, compared to the people who do have the temperament, who can be more philosophical about these market fluctuations.
My last tip is also the most valuable, and you have to start investing in yourself. Because you are the most valuable asset you can dispose of in your lifetime. This means that you have to expand your horizon, keep learning, and learn also new skills. This is also something that enriches you from a personal perspective, because keeps your curiosity alive. Plus, you have to consider that even if you are risk averse and you don't feel you have this investing spirit inside yourself, and you would like to opt for a more traditional lifestyle, having a broad set of skills will give you a competitive advantage just in case you have to find a high-paying job. Also, in this more traditional way, the higher you are paid, the faster you reach financial independence, and you can retire early, and maybe you can start investing at a second stage. It's never too late. So guys, we reached the end of the video. I really hope that you enjoy and you will stay with us also in the future. In order to do so, press the subscribe button down below and the bell. And remember that achieving financial independence is not impossible. It's a matter of being patient and committed to our goals. It takes time, effort and discipline, but however, it is absolutely possible if you follow my 5 simple tips. That are: start cutting expenses, pay off high interest debt, and establish an emergency fund. Start investing with a long-term perspective, and most notably, invest in yourself. These simple tenets help me a lot to reach my financial independence and allow me to focus on the things that I value the most, providing me a different perspective to my life and the life of the people that I care. So again, thanks for watching and see you next time. Cheers! An additional tip for free is to buy this book, Irrational Money, Modeling Behavioral Finance, in order to understand how to exploit behavioral biases and make money out of it on the stock market. Cheers! For our video on behavioral finance, you can press the link